Well, welcome everybody to our Financial Fitness Fridays. My name is Nate Quilter, and I'll be the guest expert today. So I appreciate your time today on this Friday. Just to kind of, tell a little bit about COPEC as a Central Ohio Professional Education Council, and really just educating. That's our mission, is to educate people on my aspect is the financial matters, is where I step in, but all different types of financial wellness and all other types of wellness. So, we have some disclosures here. I'm going to leave on the screen for a little bit, give you a little time to read these because we are an affiliated company, the firm I work for, as well as COPEC. So I'll leave this up here for just a little bit, give you the time to read that. Okay, so as I mentioned, COPEC is a nonprofit, just, really just want to help people out and educate you in all aspects that can help you out with financial wellness. That's what we're doing here today. Now, there are daily webcasts as well, so if you go to copeceducation.org, you'll see a few different boxes you can check on. The first one is the daily webcasts, and that's at 2 o'clock each day. And here's a schedule just to give you an idea of what's coming up. So feel free, if you're looking for a little more information, each day it's kind of more pinpoint on specific topics. In addition, there are retirement decisions workshops coming up here on the 17th. Those will all be virtual using Zoom as opposed to in person, just because some of the places we use are not available to host in-person workshops. But also you'll see this is the Financial Fitness Financial Wellness Fridays. But if you're looking for, if you have employees under you that you'd like to schedule something for a larger group that that's more personalized as opposed to these largely broadcast ones, click on that box. And in addition, if you kind of have personal information that you don't want to discuss in front of a big group, there are free 15-minute consultations you can request on the website as well. So we're going to go ahead and get right into the program here. So today's topic is 10 critical aspects of financial wellness, also known as the financial planning basics. This is a quick overview of 10 important topics that you want to keep an eye on and think about. I can spend an hour on each one of these. So as I mentioned, it's going to be just kind of a quick flyover of the different things, just to give you things to think about. Now, and keep in mind, it's a lot of ground to cover, and everybody's situation is a little different. Hopefully this just makes you think of something in your own situation or an area that you may need to address a little more, or think about a little bit more as we go through these. But we're going to talk about setting goals. It's really the foundation to any financial plan. We're going to talk about budgeting, setting up an emergency fund, using insurance to protect what you do have, using credit, and then switching over to kind of building wealth. We're going to talk about investing and tax planning, as well as two of the most common goals we see are saving for college and retirement planning. So we'll talk about those. And then estate planning is very important as well. So these are the areas we'll cover. Again, on the daily ones, a lot of times we'll really dive into these topics in particular. So, but the first thing here, the foundation of setting up any financial plan when you're making long-term projections is setting your goals. Everybody's goals are going to be different, but it's important to define your goals, write them down, and prioritize them. So you could be sitting next to somebody at work who's the exact same age with the exact same pay, but your goals are completely different. Well, the path that you need to take to reach those goals is going to be completely different. And it's good, depending on the time frame of the goal and what the goal is. It's also going to help you determine, what type of account to use, as well as maybe how to invest it. So, for example, if you're saving money to put down on a home in 6 months, hey, you want to have that liquid in a cash type of account that you don't have to worry about it changing in value. If you're saving for retirement 30 years from now, let's say, you have time to, ride out volatility, as well as, the tax advantages of retirement accounts could be very important. So it's going to really depend on what the goal is as to what type of account you're going to use for it. Again, you're going to want to make sure to, number one, write the goals down. Number two, define them. So instead of just saying, hey, I want to purchase a home in 6 months, hey, I want to put X amount of dollars down on a home in the next 6 months or 12 months or whatever it may be. You want to get that defined number so you can know if you're on track. And that's where the SMART acronym comes in. So you've probably seen this elsewhere, but it works for your financial goals as well. So you want it to be specific. Again, hey, I want to have $30,000 for a down payment on a home in 18 months. It's very specific. That number is what we want to hit is $30,000. We'll also see this a lot of times, people say, for college planning, I want to help my child out with college. Well, that's a great aspiration, but we need to define that. Are you going to pay for tuition, room and board, and books, and all living expenses, or is this just going to be tuition? And if it, for the tuition aspect, is that going to be wherever they choose to go, or it's, hey, if they go to an in-state school, or is it, hey, I want $10,000 each year that they're in school to help them out? You want to really be specific about what the goal is when you're setting that. You want it to be measurable. So, am I on track? You can kind of, make sure you want to be able to review it between the time you set it and the time you reach it, and be able to see if you're on track to reach it. So, I want to retire early. Hey, it's a great goal, but it's, hey, I want to retire at age 55 with the same spending level that I have now. Well, that's something we can see if we're on track to do. It's hard to really say retire early. Well, what does that mean? When is early? What type of standard are we shooting for? You want it to be attainable. So it's something that you can achieve. I want to save $1 million in the next 6 months, maybe not, but I want to save $1 million over the next 30 years is something that, is definitely much more reasonable and attainable. But one note on this too, is I always like to say, you want to make sure that kind of aim a little bit high on these goals. If you don't quite get there, you still might be much better off than if you had set a very low bar to cross. So, aim high when you are setting the goals, but make it something that's reasonably attainable. You want it to be relevant, and that just means that it matches up with what's important to you in your life, and that's what's going to help you reach that goal. It's, hey, if you want to buy a new home, you picture yourself in that home and make it your number one priority, and that's going to make it something that's important to you. You're going to stick with it, kind of like a diet. If you're just dieting for the sake of dieting, you're probably not going to stick with it. But if you've got a specific goal and it's on this date, this is where I want to be, and you really care about it, you're more likely to achieve that goal and stick with it, because it's going to take sacrifice in other areas of your life to reach any goal typically. Timely, I put this on with measurable as well. You want to be able to see if you're on track, and there has to be a definitive time period where you've achieved that goal. So, if I want to retire at 55, at 55, that's the target that we're shooting for. So did I hit it or not? Again, you want to write these down and prioritize them, but keep in mind, these goals can change over time. Different things are going to happen in your life that may, a goal you had 2 years ago may be completely changed, as you approach it. So it's, even though it's written down and this staring you in the face, it's okay to change them over time. It's better to change them because of life circumstances rather than you're just not on track. But if you're not on track, you can step it up a little bit more if you're looking at it each year at what that original goal is. Again, these are going to be flexible and they're going to change over time. So how do we reach the goals? Well, the first step is budgeting, and that's, budgeting is, really just controlling the cash flow coming in and going out, so you can set the cash to go where you want it to go, as opposed to just spending and seeing where things fall. So really budgeting, it's, kind of a scary word for some people, but it really doesn't need to be too difficult, especially getting started and looking at it kind of on a macro level. And then if you need to really dive down into the nitty gritty, Then it can be a little more time consuming, but the first step, again, is just starting. First, you want to just look at what your income is. What do you have coming in month to month, week to week, year to year, whatever time frame you're looking at. Paycheck, that's a pretty easy one to look at typically. But if you have rental homes, any government benefits, interest on your savings account, any investment income like dividends or bonds paying out interest, that's what you have coming in each month. And then the other side of the equation then is expenses. So, what's going out each month? So some of these are going to be fixed, things that are relatively stable over time, like, a mortgage or rent, car payments, insurance payments. Usually those are things that are, relatively fixed on a month-to-month basis. So you can expect what you're going to spend. Discretionary, these are things you have a little bit more wiggle room with. So it could be anything. I consider, even though it's something that's a necessity, I consider groceries discretionary. We can get a steak one week, but ramen noodles the next week if we need to cut back. So it's things that can change over time. Vacations, travel, things like that, gifts, these can vary greatly. Hanging out with friends. These are things you can cut back on, but if the budget isn't working out, these are the things that typically you need to cut back on, because a lot of times those fixed expenses can't change. So you've got your income and what's coming in. Now you know what's going out. If you just take what's coming in minus what's going out, if it's a positive number, congratulations, you have a surplus. You now have money to start using towards your other goals. If it's a negative number, again, some changes need to happen. And those can be either an increase in income or a decrease in expenses. And again, it's usually the fun stuff that goes away on those expenses. So those are the ways you kind of fix the issues if you do have a negative. And if it's a 1 month where you're running a deficit, it's not that big of a deal. But if it's a month-to-month thing, something needs to change. Unless, if you're retired, but then the income's just coming in from an account. So you really want to make sure that this is either even or a positive number over time. And when you're tracking those expenses, keep in mind, it can be, you want to track it over a period of time. If I ask you what expenses are right now, you may be able to, most people can name, mortgage, rent, car payments, electric, phone bill, things like that. But they may not be thinking of the holiday presents they buy in December, or the travel that they did 3 months ago, or auto repairs, things that need, or just upkeep on the car. You may not be thinking about it this month because you didn't pay it this month, but you want to look at it over an annual time frame and then compare 1 year to the next and see, if there's a big difference. Is it just a one-time thing because of a wedding, let's say? Or is it something that, hey, we need to account for every 3 years I'm going to have a home repair that costs about $10,000 or something like that. So again, it's something you're going to want to track over time. So now we're going to assume that you've figured out you've got your goals set, you figured out your budget, and now the first thing we want to do once we're in that positive budget is to build up an emergency fund. And the emergency fund is just money that's sitting there, easily accessible. It's not going to fluctuate much, but it's going to be there when you need it. And it's, things are going to come up that you don't expect. And it's instead of putting on a credit card or having to pull from a retirement account and paying taxes and penalties on it, money just sitting there in a liquid, let's say a savings account as an example. You can take out, it's there for you. And this is something we do see a lot of, very common. A lot of people don't have a good emergency fund built. I've seen statistics that say, 40% of people couldn't come up with $400. And you're in a pretty precarious situation that, it's not uncommon for something that costs $400 to come up in your lifetime. So how much should you have? General rules of thumb out there, about 3 to 6 months. I like to be specific to different situations, but in general, if you're aiming for 3 to 6 months, should you be at 3 or should you be at 6? Well, it depends on your situation. If you're at 0 right now, let's shoot for 3. But if you're already at 3, let's start building towards 6. It also would depend on your situation. If you're the sole breadwinner of your family and you have 3 children, well, you may want to build up a larger emergency fund in case you lose your job or your health takes a turn. It's the other people are counting on you for that income. So you may want to push more towards that 6 months or even a year in some circumstances. If your job is highly, let's say, commission-based, if there's a bad month, you may not have the funds to cover that month's expenses. So, if it's very commission-based, you want to maybe build up more towards that 6, maybe even 12 months. Whereas if you're married and have no kids and you could live off of one of your incomes if things happen, well, you could probably get away into that 3-month, or maybe, aim for that 3 to 6 months. So your situation is kind of help you determine how much of an emergency fund you should have. When I say 3 to 6 months, I consider that expenses, what's going out of, at least your basic needs. Whether or not you want to build in the extras, I prefer to build them in just because you don't want to have a huge lifestyle shift, but maybe not extravagant. If you lose your job, you're probably not going to go on that big trip. So keep in mind, it doesn't necessarily need to be every dime you're spending, but at least the necessities when you're deciding that 3 to 6 month time frame. Now, where are we going to keep that? So that's important. You want it to be liquid. On this, you're not worried about return on principal as much as the return of the principal. Back in, let's say 2000, or even let's look back about 6 months back in February. The stock market, let's say, dropped very quickly, in a large amount. So if your money was in a stock fund, you might be down 30% right when you need it, when people are making, when jobs are making layoffs and businesses are shutting down. So it doesn't help to have it if it's in something that's going to be very volatile. It could be down considerably when you need it. You want it nice, safe, and steady. So, cash type accounts that aren't going to have a penalty to take it out. And with that said, I've never had to write a check for 6 months of living expenses on one day. So, I like to keep in a bank, maybe 1 to 2 months in a bank that you could write a check that day or swipe a debit card that day to cover, large expense. But beyond that, maybe keep it in, let's say an online savings account to try to get a little more yield. If you're eligible for a Roth IRA, maybe you put it in a Roth IRA where you can take your own contributions out without touching the earnings on it. But again, be careful with how it's invested within that account. You want it to be liquid, something that's not going to fluctuate very much. So now we'll assume you've got your goals, you've got your budget set up, and now you have an emergency fund built. We want to make sure that there's no event that's going to really destroy everything that we've built so far. And that's where insurance comes in. And insurance is really, you're shifting the risk onto somebody else, which in this case, an insurance company, that if something happens, they'll make you whole, or at least, close to whole, depending on the situation. Insurance works best if it's an event that's unlikely to happen, but if it does, it can be very devastating financially to you. So if insurance companies know they're going to pay out something in the next 12 months, they're going to have to charge you a premium that's pretty high. If you're 25 years old and you pass, the likelihood of you passing away is very low. So these insurance companies pool in a lot of people in your similar situations and say, well, look, out of millions of people, we know that maybe, out of 2 million 25-year-olds, we know that X amount on average pass away in a year. So you're pooling all the money together. So if that low likelihood event happens to you, you can have a larger kind of windfall to make up for it. So there are all different types of insurance out there. So, obviously it's a case-by-case basis what you need. But, health insurance is very important. If you don't have it and you come down with something or even break your arm, let's say, it can cost tens of thousands up to hundreds of thousands of dollars out of pocket. Whereas if you had that health insurance that you were paying a monthly premium on, it can come in and help out with that. Auto insurance, it's unlikely you're going to get in a wreck on the way to work or on the way home or wherever maybe you're going. But if it happens, it can cost tens of thousands of dollars. And even there are two aspects of auto insurance. There is property, which covers the cars and things like, if you hit a sign, replacing the sign. But there's also liability, which is actually, in my mind, the most important one. That, if you hit a car full of doctors on the way home from work and they can't work for a while, well, guess what? They're going to come after you, or if you have insurance, the insurance company can pay out that liability aspect of it. There's life insurance. There are all different types of that. It can be over a course of a term. It can be whole life, universal, variable, all different types of life insurance, but they all are kind of at the same basic principle that if you were to pass away and people are reliant on your income, that it's a large, usually, depending on the situation, usually it's going to be a tax-free benefit to your beneficiaries that they can use to kind of replace what you would have earned over time. It can be used for other aspects, such as, if you're a business owner, things like that. But the main area is, hey, if you were to pass away, this insurance policy pays out. A lot of times, if you have a terminal illness, also they'll prepay it while you're still alive, if need be. There's property insurance, and that can be whether you own a home or you rent. And again, two aspects of this similar to the auto insurance. There's property and liability. And those are important. So, a lot of people think, hey, I just rent, I don't have that much stuff. But, well, what if somebody slips on the ice in front of your house? What if you have a dog that bites somebody? That liability aspect of it can be very important. And even the property aspect, if your house were to burn down, let's say, think about how much it would cost to replace everything you had, even, add up how much you pay for even a t-shirt, and look at that t-shirt drawer, how much it would cost to replace all of that. So property is important, but liability is equally, if not more important. And next up, liability insurance. This is also known as an umbrella policy. So this is, an umbrella because it covers if you have that property insurance and the auto insurance, but you want to really build up that liability aspect of it, you can put an umbrella policy over them. Now, they're going to make sure you have at least a certain level of coverage on your auto and property policies before they'll write that liability policy. But oftentimes you can get $1 million to $2 million of extra liability for just a few $100 a year. So that can be very helpful, especially if you're somebody who might be a target. If you're higher net worth, if something were to happen, people might want to come after you a little bit more, knowing that you have funds. You maybe go ahead and add that umbrella policy on. Disability insurance will step in if you're not able to work. And then also long-term care insurance. If you're, you need to go to a facility, you can't perform two of the daily activities daily living activities, and you need to go live somewhere that helps you out with those. A long-term care insurance policy would come in and help pay for those. So lots of types of insurance, but it's really important to see, make sure you have enough of the ones you need and not too much of the ones you don't need as much of to protect what you have. Now we're going to shift gears to using credit. Even if you budget well and have a positive cash flow, usually everybody's going to at some point be in a situation where they need to use credit. And that's borrowing money basically that you'll pay back. When you larger purchases such as a home, most people at some point will need to get a mortgage or maybe to purchase an automobile. Larger ticket items, especially almost everybody needs to use credit at some point. So if you need to, borrow money and use credit, there are 3 C's that the lender is going to look at. The first thing they're going to look at is your capacity. Are you able to pay them back? So that, how much do you earn? What are your other debts that you have to pay? How stable is your job? Things like that. This is, can you pay us back? Next, they're going to look at the character. So they've determined, yes, we know you can. Now the question is, are you going to pay us back? So that's the character aspect of it. And then the next one is collateral. So this isn't in all situations, but a lot of situations there's something that they can put a lien on in order to, if you don't pay it, they can come take it away. So on a mortgage, they put a lien on your home. They can foreclose on you if you don't make the payments. On a car, they put a lien on the auto. They can come repossess the automobile. So a lot of times there will be collateral involved, especially with larger ticket items. So how are they going to determine those 3 C's? That's where they're going to look at a credit application. That's going to say, how much do you earn? What do you owe? What other income do you have coming in from the household? How long have you lived where you live? How long have you worked where you work? Things like that. So, they're going to take down all this information to see if you do have that ability to pay and how reliable potentially. Next up is your credit report. So everybody can go get a credit report, actually more often than usual now, but in general, through annualcreditreport.com, you can request a report from each of the 3 main credit bureaus each year completely free. This credit report is going to show, how you've paid on the other debt that you've had. It's going to show all different addresses. If you moved around a lot, you might be, hey, I remember that one. It's been a while. But it's just a large wealth of information about you and your past and how well you keep up with making those payments. Finally, they're going to look at a credit score. And the credit score is, a 3-digit number that just kind of compares you to your peers and how well you do pay back and how well you use credit, how reliable you are in paying that back. Now, when you get your free credit report, it's not going to offer the credit score for free. You need to pay for that. But a lot of credit cards, and there are sites out there that you can get those credit scores for free. But just keep in mind, those might vary from place to place. So if you use one credit card and you look at your credit score, but then you go apply for a mortgage, the numbers may vary a little bit based on what each of the credit bureaus uses for their score. So when they calculate this score, they're using algorithms and that you can't go calculate the score yourself, but they are able to say, look, here's the important things we look at. And it's how long have you had accounts open? So if you don't have any credit at all, that kind of is going to bump your score down. But if you have had a credit card open for the last 10 years or a mortgage for the last 20, you've got that long history that they can see that you've paid on. They're going to look at what percentage of the available credit you have are you using. It's called your debt to income, or excuse me, your debt utilization ratio. So they're going to say, hey, if you've got $10,000 of available credit on credit cards, let's say, but you're using 9,000 of it, it's a little bit more of a risk to maybe a new lender that's looking. Whereas if you keep that ratio down, that utilization ratio down under 20%, under 30, definitely you want to keep it under, but under 20, it's really helpful as far as helping out that credit score. They're going to look at the types of loans you have. So if you're using if you have an auto loan and a mortgage and student loans and credit cards and you're making the payments on time on all those, that's a plus because they can see you can use different types of credit and pay on it well. And just keeping up with payments, are you paying on time is a big aspect of it. So again, you can't calculate the score yourself, but there are ways to get it for free. But those are the areas that make up that credit score. And a lot of people obsess about the credit score a little bit too much in my mind. Look, if you're in the mid to high 700s, you're usually going to get a really good rate. So whether it's 770 or 780, it's not really worth obsessing over. But if you have a lower score, down under 700 or under 650, it's worth to get it back. And really, it takes time. It takes making those payments on time. Sometimes maybe opening a credit card to raise up the amount you have available, so you're lowering your utilization ratio. That can help a lot of times. A lot of people say, look, I'm not using this old credit card. Should I just close it down? Well, double check. If you've got other cards that are old also, maybe it won't hurt you that much. But if you have 4 credit cards and 3 of them have been open in the last year and the other one is 15 years old, maybe you don't want to close down that old one because it gives that long history. So there are ways you can try to improve your credit score, but I would say don't obsess too much about it. Just, kind of take care of the main items, and over time that credit score will go up. Anytime you use credit, you're taking on debt. So that's, you're borrowing money saying that you will pay it back later. There are a couple different types. There's secured and unsecured. Secured is something that, there's some type of collateral that they can take away from you. Auto loans, mortgage, even sometimes if you're having trouble getting a credit card, you can get a secured credit card where you actually give them some money that they hold on to. They give you access to credit, but knowing if you don't pay on your credit card, they can come take away that account that they're holding on the side for you. Unsecured debt is something, it's where they can't take something away from you. Your student loans, they can't come take away your diploma because you didn't pay them. Credit cards in general are going to be unsecured, where, hey, they can send it to collections or come after you for that money, but they can't necessarily take something away. Whereas if you don't pay your mortgage, they can take your home away. So if there's some type of collateral, it's secured. If not, it's unsecured. Important considerations to look at if you are going to take on debt is the amount you have, your amount you're taking out, the term, so how long that you're paying that back, as well as the rate. So the more you take out, the more you're going to pay back. But typically, the larger the loan, let's say a home loan, and they have collateral. Sometimes, they'll stretch this out to 30 years. Where an auto loan, they know that car isn't going to last 30 years. So, they'll typically be in the, 3 to 5 year range, but I've even seen them up to about 7 years recently. But so depending on the type of debt you're taking, that might affect how long they're willing to lend you that money. And then, of course, the rate, the higher interest rate you pay, the more interest you're going to be paying over time. So, if you can compare two different loans, if you're going to take out a mortgage and one has a lower APY than the other one has, then you're going to save money over time on interest if it has a lower rate. So those are the three main things to consider when you're looking at it. We're going to shift gears now a little bit and say, okay, we're just borrowing. Right now we're going to talk about building wealth, and that's where investing comes in. So when you think of investing, what do you think of? A lot of people picture, Vegas. Hey, it's very speculative. Other people think of it as just a tried and true, long-term, put away a little bit of money approach to reaching those goals. It's actually somewhere in between. It's a combination. It is a carefully planned and prepared approach to managing the money with the goal of accumulating the funds you need. But there's always going to be risk. It may not be necessarily a lot of speculating and large risk taking, but there's always going to be some type of a risk in any investment you make. And really, when it comes to investing, savings is one, especially if you're younger, savings is the biggest aspect. Are you able to put money away each month, and how much are you able to? If you're saving $20 a month, it doesn't matter if you can make 20% returns on it. 20% on $20 isn't going to make as much of a difference as if you're making 10% on $3,000 a month in savings. So, really the most important aspect of it is that savings rate. And then the return on it is kind of another factor, which over time can have a big impact, but especially in the short term isn't going to have as much of an impact. So, really when you're deciding how you're going to invest, one of the biggest aspects of it is the risk tolerance. And there are kind of two aspects of this. There's your comfort level of it, which is kind of what we call risk tolerance, but there's also risk capacities. Well, how much flexibility do I have in my plan to be able to, accept volatility and risk? So really, any type of investment really comes down to risk and reward. Are you getting enough reward for the risk you're taking? Or is really the main aspect of it. And how much risk are you willing to take for how much reward? So really, a lot of it's your comfort level. Again, two people can be the exact same age, but if one of them can't handle the risk, and if they see their accounts go down 5%, they're going to sell out because they can't handle that volatility. Well, they can't, that they just can't handle that. They're better off starting off taking less risk instead of making the wrong move at the wrong time because they're not comfortable with it. But again, part of it is then your risk capacity. If you're younger and you've got 30 years till the goal that you're shooting for, you've got time to ride out that volatility. Whereas if you're retiring tomorrow and you're going to need to take money out of that account next month, make sure you've got some stability in there in order to take that out. And again, there are three different kind of aspects of those investment returns, and that's growth, income, and stability. And the more you shift from one to the more you shift towards one, you're shifting away from the others. You can't have it all. So growth is, as an example, I buy stock of company ABC for $100, and I hope to sell it for $200 a share later. You're looking for that item to be able to be sold later for a higher amount. Income is how much it's spitting out to you every month or every quarter or every year. So, if you've got bonds that are paying out a quarterly coupon or a monthly, your savings account's paying out every month, that's income that each month you can use that money for spending or more investing. And stability is more of that, that emergency fund aspect. I do not want this amount to fluctuate much, and I'm willing to forego some growth to make sure that it's there and stable for me. But so yeah, again, if you're really shooting for growth, you're going to lose out on some of that stability and income. If you're really worried about stability, you're going to be giving up growth. So you want to find that balance that's right, and also again using different accounts for different goals. So you may have that goal of retirement 30 years from now that you're aiming for more growth. but that emergency fund you're shooting towards the stability, or more of a short-term goal. You want that stability. You also want to consider income taxes with your investments. So pre-tax dollars. So if you're, let's say, at Ohio State and you're putting money in a 403b or a 457, or if you're at a private employer and you're putting money in that 401k, those are pre-tax dollars. And it's for all different things, not just retirement plan contributions, but it can be for your health insurance premiums. Those are pre-tax dollars. A lot of times you can do, bus passes or things like parking. Those things can be pre-tax a lot of times. And that pre-tax means deductions are made from your paycheck before those taxes are calculated. So even though it's $100, let's say, a month for parking, the out-of-pocket costs are lower because it's $100 before they take away those taxes instead of $100 after they took those taxes out of it. Now, there's also something to consider, and that's tax-deferred growth. So that means that during the time frame where those investments are growing, you're not paying taxes at that time. So when you put money in a 401k, for example, if it's a pre-tax 401k, you don't pay the tax when you put it in. You don't pay taxes as it grows, but when you take it out, you pay the taxes on it. In some certain cases and different types of accounts, those distributions can be tax-free if the distributions qualify for that. So as an example, if you put money in a health savings account, it's pre-tax money, but when you take it out, if it's used for a qualified medical expense, you don't pay taxes on it to take it out. Same as like a 529 for college savings. You don't necessarily get as much of a tax break up front, but it grows tax deferred. And as long as you're using it for a qualified education expense, when you take that money out, you're not paying taxes on it. Now, you always just want to know before you take money out, is a penalty going to apply? Are there going to be taxes that I need to pay? So just understand what the distribution is for and how it's going to be taxed or if there's penalty. This slide is a hypothetical example just showing that taxable growth versus tax-deferred growth. So let's say you had $20,000 and you put $10,000 in a tax-deferred account and $10,000 in a taxable brokerage account, as an example. This assumes the same growth rate and the same tax rate on both of 24%, and assuming that you pay the taxes out of that taxable account, as you owe those taxes. So the tax deferred account, similar to a 401k, if you put $10,000 in today, don't pay taxes on it till you start taking it out. If we look down the road 30 years, that $10,000 has grown to about $57,000 if we assume a 6% rate of return every single year. Now, that's $57,000, but when you take it out, you have to pay taxes on it. If we use that same tax rate, it's about $43,000 after tax. As opposed to that taxable brokerage account, you're paying taxes along the way on that. It only grows to $38,000, still below where that tax deferred growth was after paying the taxes later on. Again, this is just a hypothetical example to illustrate the point. So what are we saving for? Two of the main goals we see are college planning and retirement planning. So, when you're saving for college, there are different ways to do it, but really 529 plans are the most popular option, and for good reason. The tax deferred growth and tax-free withdrawals, if used for college, are really helpful. There are two different types of plans within 529. So 529 is federally kind of ruled, but each state has its own plan. It's ran through the states. And you can open a 529 in any state, and the funds can be used from any state's 529 plan. If you're looking at a college savings plan, could be used anywhere, no matter where they go to college, as long as it's an accredited college. But so there are the college savings plans, which I like to kind of think of as a 401k. You put money in, you determine how it's invested based on the available investment options there. It's going to fluctuate based on how you invest it, but these funds can be used, and the amount you'll have to be used later on is all going to be based on how much you put in and how much that grew. They've even opened it up recently to being able to be used for kindergarten through 12 as well, tuition for those. Um, there are also prepaid tuition plans where you pay the tuition today. They guarantee the return in the form of, college credits, basically. Now, you are limited to putting it in with your own state, and in Ohio, this plan went away years ago, so you can't add to those right now. So really kind of move past that pretty quickly for that aspect. But and it is limited to using in-state public. If somebody has one out there still, it's limited to in-state public institutions typically. So again, these 529s offer tax-deferred growth and tax-free earnings, potentially if used for qualified educational expenses. It's not like a 401k where you get a full, it's pre-tax money necessary. There are, if you use the Ohio plan, there can be state income tax savings. They're limited to about $4,000 a year, but so there can be a little bit upfront, but most of the tax benefits are going to be in growth and when you take it out. Now, if you don't use these for qualified education expenses, they can be subject to income tax and a penalty. So, careful not to overfund these. But if you do overfund a little bit, the beneficiary of the account, so who it's used to be paid out for college, that can shift. So if you have 3 children and you've got $10,000 in your oldest child's account and they don't go to college, you can just change the beneficiary to child number 2. Now, keep in mind when you're looking at these plans that there are fees and expenses associated with it, both within the plan and within the investments within it. So you want to make sure to keep those, keep a good eye on those. But yeah, the Ohio plan is always highly ranked if you're here in Ohio. Next up is retirement. All of us hopefully at some point hope to retire, and the age of that, can vary greatly. But, our firm is called Retirement Strategies that I work for, but, we really prefer the term financial independence. It really just means that you have the funds to be able to be independent and do what you want to do. It may be that you continue working. You're not necessarily retiring in the traditional sense, but you at least know, hey, I'm here because I want to be, because I am financially independent. So the main thing here is the earlier you start, the better. Number one, planning, seeing, am I on track? And number 2, investing, getting that money working for you towards retirement. So this is just another hypothetical example. It can be difficult to catch up later on. So this shows if you were to put $3,000 away every year into a 401 type, a tax-deferred plan, like 401k, for example. This again assumes a 6% annual growth rate, and that any earnings are just reinvested within the account; they stay there. If you start at age 20, $3,000 a year with 6% growth gets you up to about $680,000 by age 65. If you don't start until you're 35 years old, that it would grow to about $254,000. So quite a difference because of those 15 years. And if you delay to age 45, and put in $3,000 a year, it would only grow to about $120,000 at a 6% rate. So again, this just really hypothetical illustration just to show the early you start, the better. It's compounding interest, and that's your earnings earn money on themselves, and the money really gets working for you. And the compounding to have really big effects really takes a little bit of time. If you earn 10% on your first $3,000, well, congratulations, you earned $300, which, hey, it's still good. But if you've now built that balance up to $300,000 later on in life, and you're in that 10%, well, you're earning $30,000. So those compounding gains really have a huge impact the longer you let that money grow. So important considerations to think about, when you are planning for retirement is the biggest one is, what do you want out of retirement? Close your eyes and picture, do I want to travel the world, or do I want to just relax at home and read library books? The way you picture your retirement is going to have a huge impact on how much you need to retire. Do you want that freedom to travel? Do you want to live where you are? Do you want to cut back on your home size or buy a second home? Everybody's own goals and situation are going to be different based on what they want out of retirement. So that's the first thing you need to kind of decide. And it can be hard if you're 20 years old to decide what's 70-year-old me gonna want. But as you get closer to retirement, you'll have, that picture will become clear. So we just want to make sure we're kind of on track when you're younger and doing the right things so that as you get closer to that retirement, you can know if you're, hey, am I okay to retire? So that's where, when do you want to retire? Obviously the earlier you do it, and the younger you are, the longer the money needs to last you, because if you retire at 60 and you live to 90, the money has to last you 30 years. And the other aspect of it is you have less time to save, number one, you need it to last longer, and number two, you don't have as much time to save for it. So you may need to be more aggressive in your savings when you're younger if you want to retire, at an earlier age. Important things to consider is Social Security isn't even available as an option until age 62. And then there's also, the longer you delay Social Security up to age 70, the more you get. So if you retire at 60 years old, you may not be able to get Social Security, or you definitely can't get Social Security, but if you started at 62, you're not going to get the full benefit potentially. In addition, Medicare you're not eligible till age 65. So if you retire at age 60, what are you going to do for healthcare between 60 and 65? Some employers or, like an OPERS or an STRS currently offer it, and those are always shifting. Maybe they offer a subsidy down the road or whatever it may be. But keep in mind, what are you going to do for healthcare? That can be, we see a lot of clients that stick it out to work till age 65 just because of the healthcare aspect. And again, how long will that retirement last? So, if you're 65 and you expect to live to age 90, you need that money to last you 25 years. I've seen the statistics with the healthcare breakthroughs we've had. The statistics show, people are living longer because of medical breakthroughs and, healthier lifestyles. There's a good chance that you're going to live to age 90, 95, even 100 years old. So you want to make sure that those funds are going to last at least as long as you do. Plan ahead for those events, long-term care events, or what happens if somebody passes away early. That's where all that planning comes in to make sure that you are on track. Going back to those tax advantage savings vehicles, these are ones specific towards retirement. So, that we showed before how that tax advantage can really help over time. So if you've got 401ks or 403bs or 457s available through work, some employment like Ohio State, you're considered nonprofit as well as government. So you can actually save in both a 403b and a 457 up to the limits if you have the cash flow to do so. If you're in an OPERS type situation, hey, you've got that pension, or you have Social Security, so those incomes are going to come in later. Roth IRAs, again, you don't get that tax benefit up front, but you get it later on down the road. But again, just keep in mind, what is this money used for? How old am I going to be when I take it out, most likely? Because if you go into it sooner, there could be taxes and penalties. I'm going to briefly touch on estate planning. I know it's, Russ Scallowin is one of the presenters who he's an attorney and really, gets into the estate planning details. But fundamentally, the main thing you want to keep an eye on are those really important estate planning documents such as wills, power of attorneys, things like that. So I am going to touch on that briefly today. The first one is what's called intestacy, and that's if you pass away without a will, you die what's called intestate. Now, the good news is, don't worry, your money will go somewhere and it's already planned. The only problem is it's not you making those plans. It's the actual state that you live in has it decided where these things go. If you don't have a will to say where you want it to go. So it's important that, the will is your chance to say what you want to happen with your assets. So a lot of these can run into, a lot of problems, particularly if it's, it's a blended family, or, it may not go to where you want the money to go. So that's where you want to write up a will. Make sure you follow the state laws. I always recommend talking to an attorney when you're doing this. Make sure it's done right the first time, so that the problems don't arise later. But the will is your way to direct how you want your property to be distributed. If you have children, this is your way to say who you want the guardians to be. You can say that in your will. You can also accomplish other estate planning goals through these, minimizing taxes. Each state has their own laws as far as what makes a will valid. So again, make sure it's valid in that state. If you're moving to another state, double check, is my old will that I have written back there still good, or should we redo it with somebody with an attorney that's in the state that I live in now? But in addition to the wills, also how your assets are titled is going to have a big impact. So for example, if you have a 401k or a 457 or 403b retirement account, naming beneficiaries on that actually supersedes what your will says. So if I was 20 years old and I named my girlfriend at the time as the beneficiary, but now I'm married with children and my will says, my wife gets the assets. Well, if I pass away, it doesn't matter what my will says. If my beneficiary on the account says my ex-girlfriend, let's say, the money goes to where the beneficiary says. So number one, get a will in place, but also those attorneys should maybe help you out, as well as making sure your assets are titled and the beneficiaries are labeled correctly on those accounts. So beyond just a will, what's going to happen if you're incapacitated? So you haven't passed away, but maybe you're in a coma. Maybe you have some type of brain injury where you can't think and act for yourself. There are different types of documents in the estate world that can help with this. So, let's say you don't have any estate documents in place and you're in a coma. Or you're in just an auto accident and they need to perform a surgery, but they need to decide, well, how are we going to handle this one situation? Are we going to amputate or try to leave it, whatever it may be? Naming a healthcare power of attorney can be your way of saying, this is who I want to act as me. Or in a financial aspect, a financial power of attorney. This is who I want to handle my finances if I'm not able to do it myself. And if you don't name it in these documents, it can create a burden on whoever it is somebody's gonna have to go be appointed a guardian, go to the court to ask for money, or go to it's just extra steps for them that, if it's a friend or a spouse, they're already going through a lot. You don't want them to have to jump through extra hoops. And in addition, it's your way to kind of, you can have a guardian who understands what you want. That you'll see in the news sometimes these court battles of, hey, my spouse says this is what I wanted, but my parents said this is what I wanted, and they're duking out. So this is really your way to say, this is who I want to act as me. Or in the case of a living will, if I am incapacitated and these doctors say that I'm not going to come out of this, I'm brain dead. It's just a body laying there, but potentially. How do I want to act? Do I want that life support machine kept going, or do I want them to pull the plug? That's where a living will can state that. So those are just a really brief touch on important estate planning documents. But please, if there are other areas you want to hear us talk about, please check out the COPEC website. There's again daily webinars on there. You can sign up to have speakers come out for all different areas to your employer potentially. A lot of options, and we're just here to educate. I hope this was helpful. I appreciate your time today. And again, if there are in future presentations, we'll kind of deep dive in some of these topics. So if there's one that you're really interested in, keep your eyes open for, maybe we'll spend the whole hour on just investments or on just estate planning, things like that. So again, thank you for your time. If we can help in any way, just feel free to reach out.